Fintech Chatter, brought to you by Tier 1 People, leaders in Fintech executive search. Welcome to Fintech Chatter, the show where Fintech leaders join me for a chat. Today's guest is Chris Brycki, the founder and CEO of Stockspot. Chris started Stockspot so that Australians could invest better with affordable smart tech and good advice. I've watched his vision come to life as a user of Stockspot. And today, Chris shares his insights from the latest Stockspot Fat Cat Funds report, which exposes the excess fees in super and provides more transparency on fund performance. And as one of Australia's first wave of fintech founders, I also chat with Chris about his journey building a bootstrapped business and how remaining lean is paying dividends as we enter a downturn. Chris, welcome to the show.
Thanks for having me back, Dexter.
It's been a little while, so yeah, it's really good to have you back.
Yeah, that's it. It's I guess it's good news when you can interview someone several times in the fintech space, means the business is still around.
Yeah, mate. And so I think it was a very different world the last time we spoke, or it seemed that way. We were kind of in the, I think, midst of or coming out of a pandemic. In fact, we caught up, I think, just at the end of last year, and we're probably, fairly optimistic about 2022, and it's turned out to be a very different year.
Well, that's it. Yeah, out of one crisis and into the next.
Yep. So, which I guess, look, it's really apt that we've got you on the show talking about that, because your whole kind of investment philosophy, the Stockspot business, is, I guess, fundamentally built around planning for these types of events and things that happen in the world that are completely out of our control. And also, I guess, we got you on to talk about the Fat Cat report that you release every year. But before we do that, would you mind kind of sharing with some of our listeners who might not be aware of Stockspot a little bit about what you do and the kind of origins of the business?
Yeah, absolutely. So Stockspot is a online investing business. I would say we were the first robo-advisor in Australia when I set it up back in 2013. In a very simple terms, we help anyone in Australia or everyday people invest their money in a way that's sensible, to save up for their long-term goals, and we try and make it really, easy, safe and consistent for them so they don't have to worry too much about investing. It can just happen on the side and they can get on with their day-to-day life.
So the kind of, we go back to 2013 when you started the business, fintech was just kind of starting to, certainly from my perspective anyway, kind of enter my psyche as a word, and we were seeing things that were happening in the UK and the US. What was it that I guess kind of got you to start Stockspot in the very beginning?
Well, yeah, I do remember that fintech wasn't really a word back then in Australia. And so when I was describing the idea to people, it wasn't, something in my vernacular to use. I would describe it as a website that people would go to have their money professionally managed for them, so they didn't need to see a broker or an advisor. So certainly the industry's come a long way, and there were the green shoots of fintech coming out of the US and the UK. I think after the financial crisis, I think there were a few reasons for that. A lot of people lost their jobs in the financial crisis, so we're looking for different opportunities. But also the financial crisis itself, I think, was a bit of a shake-up for the industry and led to people realizing they could create new businesses to really focus on a particular vertical, whether it was lending or investing or something like that, and be better than the incumbents and attract a customer base that way. So the fintech that started in that part of the world, eventually seeped into Australia. I think I started to really see the growth and the use of the word and more businesses pop up probably in that 2016, 2017, 2018 period. And Fintech Australia, which was the organization that was set up quite early and originally only had a few members. You can sort of see it through membership numbers as well. There's a lot more companies popping up as well.
Yeah. So can you tell us a little bit more about Stockspot as a kind of a product and how it works, and kind of what kind of impact it's had on customers?
Sure. Well, I mean, the inspiration really was that I had a lot of friends and family members who would always come to me for investing advice, and I worked in the investment industry, and always thought that there was an opportunity to help service them, and not just them, but all of the others out there that don't work in financial services, but ultimately need some help managing their finances. And I realized that it was very expensive to go see a financial advisor or a broker. And a lot of them won't talk to you unless you've got $500,000 or maybe even $1 million in assets to invest with them. And then even when you do go and see one of them, often the advice they'd give you was clouded by conflicts of interest.
Yeah.
And so it wouldn't always be the best advice. So I thought there was a great chance to use technology to create a direct-to-consumer business to help manage people's wealth that could cut out a lot of these conflicts. And so, we could basically unravel some of the relationships that existed between product manufacturers, and by that I mean funds or shares or the types of investments people make, and the advisors that were recommending them. And that really, kicked off the journey of starting the business. It was originally just to help a handful of my friends and family members. But I thought if those people are having this problem, then there must be lots of others out there that, are parking all of their money in a bank account and earning a pretty average return relative to what they could get elsewhere.
Yeah. As a user of the product, I mean, one of the things that I found as well, and you might like this story, I actually went to see a financial advisor maybe about 2 years back. And when he asked about Stockspot, because he wasn't aware, because you weren't on the panel that they were allowed to use, he basically told me not to bother spending any money on getting a financial advisor because the product that I already had were actually really good, and he didn't know what else he could advise other than just around property. So
sounds like you got a really honest advisor, and you should probably hire them.
Yeah, but it was kind of really cool, that he'd kind of looked at the Stockspot product and was like, oh wow, I wish I could actually offer this. Actually said, I wish I could offer this to my customers.
Well, happy to have a call with him and know him how he can. I mean, I think, there's certainly a group of advisors out there that are realizing that a lot of these technology solutions can actually help their clients' lives, and actually their time's better spent on, other areas. Maybe it's property or doing your estate planning or your insurances. So it's certainly what's happened in the US and Europe is that robo-advisors are now working with a lot more advisors or a lot more, banking institutions to solve that problem and allow them to focus on other areas that they're expert at. And, ultimately, I think that's what will continue to happen over time. The role of a financial advisor will become more of a curator of the best financial services out there, and they won't be tied to a particular platform. And it sounded like your advisor was tied to a particular approved product list, which is quite common in Australia. Unfortunately, at least historically, the approved product lists were often products that they're the business that employed them would be able to monetize or earn some money from. But usually the best products out there aren't paying these sort of commissions, and so they don't end up on the approved product lists. And I've had this conversation with a lot of the index fund issuers out there that really struggle to get onto platforms. And it's because they can't pay the sort of margins that other products do. And so you have a bit of an adverse selection process out there where the worst products end up on all the platforms because they're the ones prepared to pay for distribution. But the best products, a lot of people don't hear about. And I thought that was a problem worth solving.
Yeah. Now, kind of leads nicely onto the Fat Cat report. Can you tell us a little bit more about what it is?
Well, this is an idea I had even before starting Stockspot. I really thought there was a big education piece missing in Australia to help people understand what's really important when they invest, and what better place to start than super, where everyone has money invested. So back in 2013, before I launched Stockspot, I spent a lot of time downloading all of the data from super funds in Australia. I literally went to their websites, found their performance pages and downloaded it into a spreadsheet. And in that first year, I think I covered a few hundred, and that's grown over time. But the idea was to really do a deep dive analysis into how super funds perform and try and work out what are the key determinants of success, what leads to one super fund being successful and another one not. And so we've now done this research for 10 years in a row where we've got as much data as possible from all of the super funds out there. from what we can see, we've got as much data as even the regulator, at least the regulator is publishing on these funds, because we can't find it anywhere else. That's why we're actually having to go to their websites. And we're able to come up with some really helpful insights, we think, for people out there trying to make a decision about where to invest their super. And every year the insights are relatively similar, that low fees is better than high fees. Every cent that you pay in fees is a cent that comes out of your retirement. So pick a fund with low costs. There is a belief out there that bigger funds always do better. We're a little bit skeptical about that based on the data we've seen. And actually there's a lot of smaller funds that do all right as long as their fees are pretty low. And really it's also very important for people to make sure they're comparing apples for apples, because in a lot of the performance league tables that you see, even published in the newspaper or on TV, you're comparing, a very risky fund to a very low risk fund. Mm-hmm. So it's not really fair to compare those funds in the same, in the same table.
And what were kind of some of the things that really stuck out to you being a fintech guy?
Well, I think I, probably had a bit of a romantic belief when I first launched this research, that as soon as you publish it and it's out there in the open, everyone will leave the rotten products, and that will be that. That as soon as the information's out, everyone will make a sensible decision and leave. But I think what I've realized over 10 years is that super is one of these areas that, one, not that many people care about or think about. There's a lot of apathy. There's a lot of friction to change funds. And it's a bit of a broken product out there, because everyone in Australia is forced to have it. But no one really, a lot of people don't really think about it till they get a lot closer to retirement. And as a result, where in other categories, and I often give the example of medicine, if there was a product that just was consistently not performing and, that was actually making people more sick, or, wasn't actually delivering on providing whatever health benefit it's promised, it would be recalled or pulled from shelves very quickly, or at least, it would be on a current affair and people would stop using it. It was fascinating to me, and still is, that doesn't seem to happen in super, despite the best efforts of, research like ours, or even the regulator, APRA, putting out notices about which funds are doing well or poorly, people still stay in the dud funds. Mm. And, to me, that sort of, made me question a lot of my beliefs, but also I think it made me, more, believe that government actually does have a bigger role in superannuation to make sure that people end up in funds that are right for them. Because it can be very costly being in the wrong fund. And a lot of people don't even choose which fund they're going into. It actually is defaulted by their employer. And so particularly for a choice that you're not even making in society, that the government's forcing you to make, the government should be responsible for ensuring that, that those choices are well made.
Mm. We've seen a few fintechs in Australia over the last 5 or 6 years try to tackle the problem, and it's not kind of worked out how they originally planned. What do you think you kind of put that down to, and what do you see as the big opportunity here, or the big problem that fintechs potentially could solve?
Well, super is, first of all, a very complex area. So if you're going to, if you're a fintech trying to solve a problem, super is extremely complex, because there's a lot of regulation. There's a lot of history behind it. You need to be able to understand, the investment side of things, but also the regulatory side as well. And I think, probably some of the earlier fintechs trying to solve the super problem by launching products, probably didn't have the depth of, knowledge and experience needed. To be perfectly honest, they had quite small teams. The teams were generally fantastic at marketing. And generally that was their value add, was that they believed that they could acquire lots of members very quickly. But then they were missing a lot of the other bits and pieces that are required to run a successful super fund. So there was a few fintechs that have succeeded, but unfortunately a lot more that haven't. There's a lot of other business models that have come out to help consumers make better decisions around super. I think a lot of them have struggled, for similar reasons. It's a very complex area. But unfortunately, there's a lot of apathy as well. So how do you spruik the interest of people in something where there isn't a lot of interest in it in the first place? And we know in Australia that the switching rate of super is something like only 2% a year. So if your whole audience is only 2% of people and 98% don't care, there's not a lot of people to work with, and that's why we tried to make our Fat Cat report a little bit edgy and a little bit controversial, because really to get the interest of the people that we wanted to see this report to make better decisions, we didn't think we could have a boring report that no one would pay any attention to.
And I guess from that report, who are the best performing funds out there?
Well, it varies every year, Dexter. But I mean, the consistent trends are that the lower fee funds tend to do better over the long term. But particularly obvious is that the really high fee funds inevitably do very badly over the long run. And so fees is the first sort of step. There's been a few that have consistently placed in the top league of the league tables that we've seen. So this year, number one was Qantas Super, which was actually the corporate super plan of Qantas. And Uni Super often comes up the top as well, which is a not-for-profit fund focused on the education sector. Towards the bottom of the league tables, it probably won't be a surprise to a lot of listeners that it was the bank funds, that have actually faced a lot of scrutiny as well after the Royal Commission, that feature in those lists, really just because of high fees. And so OnePath, which is a business that's been sold quite recently, actually is the fund that has been the bottom performer for 10 years in a row. And that one I really struggled to get my head around. How could a product that's so obviously so bad just continue to exist and continue to, unfortunately, earn fees from people for such a long period of time?
What do you see maybe then kind of, if businesses are looking at, or founders are looking at kind of tackling a problem, what do you think is the problem within this space that maybe has got the most upside? And how do you think, kind of you could go about possibly tackling that problem?
I mean, I think there's a lot of there's a lot of upside in helping people pick and stay in the right option over the long run. But that is complex because of the rules in Australia around advice, but also I think, and more importantly for fintechs, you can offer any sort of service that's useful, but you also need to think about how you can monetize it over the long run. You've got to really think about how are you going to be able to provide a valuable service to people that they're actually prepared to pay for. And so how do you actually demonstrate that you're adding value? And super is an area where the demonstration of value add only happens over the long run. You probably won't see a lot of difference year to year. And in fact, it may look like you've made the wrong decision when in fact it's the right decision, just because of random chance over the first 1, 2, 3, 5 years. But actually over 30 or 40 or 50, it's going to be quite obvious that you've made the right decision. So, and it's a challenge, I think, in a lot of investing type services, is the real value add is the compound growth over many, many years of making the right decision up front. But it doesn't really seem like you're getting a lot of value, maybe in the first year.
Yeah. Now, if we kind of looked at, I guess, the Stockspot business and kind of the approach that you've got as well, how have you gone about kind of making, because I think one of the things I really love about the Stockspot product is it's kind of like it's getting the opportunity to invest in something like a Magellan, but I don't need 50 or 100 grand to get started. I can start off with just a couple of $1,000s. How do you kind of keep the fees so low and yet still maintain a really high performing, consistently high performing product?
It's a good question. And I think, different fintechs have tried to solve it in different ways. Like definitely the trend over the last 5 or 10 years, it's only really starting to reverse in 2022, is that a lot of fintechs just offered a service at no cost or next to no cost just to attract an audience. And in a lot of cases, they were very successful in attracting the audience. That the problem is that it cost a lot of money to fund that business model when you don't actually have revenue coming in. And when capital markets turn off and you can't be supported with external capital to support your business model, you actually have to start to charge those customers. So we decided that wasn't the right approach for Stockspot. And very early on, we tried to work out what is the sustainable model for our business. What's the right amount to charge clients so that they're getting value, but also we can sustain our business without constantly relying on new shareholder funding. I think, pricing is a very important decision for all fintechs. It might not be one that a lot of fintechs think that much about early on because they're so excited about their new innovation or new idea. But really finding that right price point, is incredibly important, because it's also difficult, not always impossible to reverse. It's hard to increase your fees over time, particularly if the reason a lot of your customers have signed up is because it's a free service, for instance. Really thinking about your strategy on pricing is important. We've tried to build a sustainable model that's not too reliant on external capital, and where customers are helping us invest in continuing to improve the service, the features, and continuing to make it a better product. But it's a tricky equation.
Yeah, one of the reasons I was kind of really keen to get you on the show is, you and I have had this chat, I think 3 or 4 times over the last 3 or 4 years, Chris. And I've, massive admirer of what you've done with Stockspot, but also the way that you've gone about it, and kind of bootstrapping the business from early days. Your marketing and content strategy is something that I, will admittedly say inspired me, to do what I do as well, and some of the approaches that I've taken. What was it that I guess kind of, from that early days of the Stockspot business, what was it that inspired you around the strategy that you had and the kind of plan of, hey, well, this is how we're going to get to market, knowing the things that you do around it being a very difficult market, a really tiny segment, big education piece, right? Of getting, which is really difficult to educate people and to come and then, trust something which is a financial service, which is a challenge to overcome as well.
I think more than anything, bad luck. I think early on I tried to raise venture capital, Dexter, but I was unsuccessful. And so I had to work out another way. Because I think what I realized was, venture investors are looking for a certain payoff. They're looking to buy a basket of options where they accept a lot of them will fail and hope that 1 or 2 pay off big time. But what I realized is, as a founder, you don't actually want that sort of risk reward. You don't get the chance to found 100 businesses and hope that one of them pays off. If you're lucky, you get the chance to found 1 or maybe 2. And so you really need to, skew the odds back in the favor of success, even if it reduces the upside of hypergrowth. And so I think, my approach to growth was one of, developing it organically over time from a product that customers trust and like and use, from a track record of performance that's going to take time to build. And I didn't think it was the right approach to, just throw a lot of money on advertising very early on in the game, which is typically the model that venture investors want to fund. They want to fund an idea that has some traction and is really ready to really ramp up very quickly. Whereas I just thought, this is a model that will continually build on itself. And so that's not really going to work. So, to answer your question, I think it was from learning that about, this business that made me realize that a certain group of investors wasn't right, but also a certain model of growth wasn't right. And also a certain type of growth was, better. That type of growth, as you've kind of alluded to, requires more patience, just like our own investing strategy. And it's one that just takes time to blossom. So I guess I accepted early on that this was a business that wasn't one that was going to, suddenly be successful in, 2 or 3 or 5 years, that ultimately it was going to take a lot longer. And that's why I'm still here today. It's a grind, but by developing great, helpful and useful content and education for customers, by giving great customer service, and consistent sort of performance, they were the ingredients that I think have helped to set us up for long-term growth.
You've obviously kind of had that kind of steady success with the business, but go back to mid 2020, we all thought the world was going to implode, and it didn't. The exact opposite happened, and we've seen frothiness in the market, not just the investment markets, but capital being thrown at businesses like yours. How did you resist the temptation to kind of get swept up in all of what was going on and thinking, hey, yeah, great, but forget it. Like, I'm going to roll the dice and see if we can, kind of hyper scale now.
Well, I think, first of all, our investing philosophy helps because, our belief at Stockspot is that the future is really unknowable. So you shouldn't be trying to guess the future of markets or where things are heading. And you should accept that there's lots of different potential futures that you need to be prepared for. And so the way we build portfolios accepts that it's hard to know what's going to go on in the future. And therefore you need a bunch of different investments that will help you in different environments. Now, definitely the environment of late 2020 and 2021 was that, capital was very cheap. It was free flowing and it was very easy to access. And therefore, there was a lot of temptation to use that cheap capital to try and grow quicker. And what we saw in other markets was businesses in a similar place to ours, but also new businesses in Australia, really focus on the area where there was a lot of initial growth, which was, retail day traders and retail investors wanting to, take advantage of these great market returns that we were seeing. So, why did we not get into that space of, share trading or crypto trading? Probably, Dexter, because I share some of the cynicism that I know you have about anything that, suddenly, becomes popular with a lot of people and that there's generally a reversion to the mean that's pretty painful. Mm. And the more excited the masses are, the more painful the reversion to the mean.
Yeah.
I saw a lot of, interesting new businesses popping up, but ultimately trying to acquire customers at any expense, which, doesn't make sense economically for us. But also, unfortunately, I saw a lot of people getting into a type of investing that I know from my, previous career is very difficult to sustain and do well for the long term. And even though a lot of these new day traders and people that were interested in crypto and share trading might do well over the short term, they were probably going to learn a hard lesson soon. Yeah. And they were going to be customers, regardless of which business they signed up to, they were going to churn and leave when they realize how hard it is. So we just stuck to our knitting and continued to explain to customers that, we think the right strategy over the long run is to diversify, keep your costs low, not get too excited. And it was difficult because our returns were lower than some of these exciting assets and investments for a period. But, on the flip side, this year when some of those investments have fallen by 70%, 80%, 90%, our portfolios are down by much less. They're down less than 10%, and so it's a survivable loss, I call that. Whereas if you've lost 90% in an investment, that's it's a very difficult one to survive and continue on with. So
you're looking at a 10x return, right, to get back to where you were.
Well, that's it. A 90% fall, people don't realize it. It takes a 10x to get back to square one. Yeah. Whereas if you're down 10%, you only need something to go up by 11% to get back to square one. So, we just stuck to our knitting and we saw all of the excitement that went on and, let it happen. And a lot of other robo advisors, even around the world, did get into crypto and share trading and lots of other of these, exciting areas. I have seen, though, over the last 6 months, a lot of them have been cutting back in those areas and actually getting out of them because the cycle's turned in a big way. So, I think that's sort of, vindicated our decision to some extent.
Now, one of the biggest challenges with bootstrapping a business, and taking the approach that you have is, particularly over this last 5-6 years, it's not necessarily been the narrative that top talent want to hear. It's not been the kind of, the glitzy, we're a unicorn, with rainbows and rocket ships. And, that's just not been your style. How have you gone about attracting the talent to build what is a really great platform, a really great product, but also, it's something that you've been doing consistently now for 5, 6, 7 years?
Well, first of all, I think we try and find people that really believe in our vision and our mission and really buy into that. And that's something I've realized is even more important now than, 5 years ago, because for people to really, put everything into the business and really stay through the good times and bad times, they need to really believe in what you're doing, I'd say, first of all. But it's a good question. I mean, there's been a lot of exciting fintechs coming to Australia, launching in Australia with huge budgets to bring on top talent. I think what we've sort of said to people as well is that we're building a sustainable business where you can be here for a long time, and there's going to be a lot of these businesses popping up that see Australia or see this market as an option and roll the dice for 12 months, but a lot of them won't survive. And so you can get paid well for 12 months, but then, you'll unfortunately have to go and find a new role because a lot of them will, not survive. And if that's something that someone wants, to be in a business where they're rolling the dice, having a crack and it may be that they're finding another role in 12 months, then, good on them. Like it's probably, we're probably not the right business for them, but if they want to build a career for many years and be part of a business growing sustainable in a more sustainable way, I think that's where we could really help someone's career. But also I think the sort of second layer to that is, a lot of times in startups and fintechs, employees may get some, participation in the upside of a business through shares or options. And it's something that we've done with our employees. But I've explained to them that, in building a sustainable business, it's going to give them the best chance of actually doing well long-term from their shares as well. So, a much better shot than getting options in a business that blows up after a year or two is getting shares in a business that's, gradually growing in value year after year after year. So, people that have seen the value of that, I think have come to us, but, it's been, I would say, very tough when there's been, businesses either raising capital here or coming from overseas with huge budgets of $30 or $50 million to set up teams and really are, prepared to pay anything to get the team on board to have that roll of the dice.
Goes back to what you were saying before as well around the investment piece, right? And the kind of the noise that, we've had, consistently around this space and the startup space, around failure and, keep failing. Like it's a good thing, right? And it's not. Like when you're running your own business, failure is kind of not an option. And it's about, kind of how do you minimize risk, right? Like it's not about constant upside and just taking wild gambles and rolling the dice all the time. But it's like, okay.
I think, it comes down to the individual running a business and also the shareholders and what they want in a business. There probably are a lot of people that have come out of corporate jobs and are really happy for that risk reward. I'm going to go big this year. Either I've created a unicorn or I'm going back to my, corporate job in a year's time. That just wasn't my risk profile.
Yeah.
I didn't want to go back to the corporate job. And to be honest, after publishing that Fat Cat report a few times, I probably wouldn't be able to anyway. So I didn't have the backdrop of getting back into corporate banking Australia. And so I had to be a bit more cautious about not blowing up.
It's look, I think this is kind of one of the cool things about having you on the show, right? Is that we keep talking about things like diversity, right? In this space. And yet everybody thinks that we all think the same and we have the same appetite and risk appetite. And, we all want to kind of build these unicorns. Some people just want to build a sustainable business, right? Like I want to build a business that my kids can be proud of. That's the thing that drives me. And I think we've kind of lost sight that it's not just about building unicorns, but it's actually creating a product or service that creates value that, you can kind of be proud of and be part of something.
Yeah, I think, I've learned that even from within our team is everyone's motivations for working somewhere or doing anything is different. And you can't assume that your motivations are the same as everyone else's. But also I think it's a good lesson that, you shouldn't model your motivations, from others either. When starting a business, if there's other founders listening, you should really be thinking about that carefully at the start is what do you really, want out of this experience? Because that will probably shape a lot of decisions that you take down the line.
Absolutely. So when you kind of look at the people that have been successful at Stockspot, what are some of the things that you think makes them a successful hire? What are some of the qualities that they've got?
One would be like a thirst for learning, because typically at startups, and certainly here we've got a pretty small team still of 20 people. And so you can't just do one thing. You have to be able to, learn other skills and be helpful, across a few areas of the business. So, an interest in picking up new skills, an interest in learning them and applying them to your work, sets, people apart within Stockspot. And working out, within the business, what are those areas where you can, help out and contribute. And I think also just a level of, grit, because, there's a lot of things that don't go perfectly, and there's things that don't work and that break, and there's a lot of, little obstacles along the way to getting out a great product and to having a good customer experience. And you need to be able to come in every day and face those challenges and get tripped up by them and still be happy to get back up and go again. So, that's what I would say is, definitely the thirst for learning and working not just in your own little niche, but across a few areas. And definitely when I've been hiring people, and particularly more senior people that have come from, corporate land where they've been for a long time, that's something that has come up in the interviews, is really, to understand their willingness to broaden the scope of their role. And if there's someone that really likes to do, one thing very, very well and just do that one thing, there are some roles within our business that's quite suited to, but there's also some roles where it's just not going to work.
And it's a challenge, right, to kind of try and get that out of people, because if you ask them, you ask somebody, hey, do you like learning? Yeah, I love learning. Yeah, I want a varied job. Yeah, I'm really bored doing the same thing. But it's one thing saying it. It's a totally different thing trying to do it. Excuse me. It's a totally different thing trying to do it in the, kind of context of a startup where you don't have the support, mechanisms that you've got in a large corporate. You kind of can make mistakes and people will carry you.
It's very hands-on, I'd say. Like, in a bigger organization, you're usually used to a team supporting you, particularly on the more simple sort of basic part of your role if you're more senior. Whereas, within our business, to give you one example, in people and culture, we've only got one person. So, and that person, she would have had a huge team of people in her previous roles. But here she's got to, be involved in everything from, payrolls, which is something I think she said she hasn't touched for 15 or 20 years, through to recruitment, through to, employee benefits, through to training. So, you really, you've got a very broad role compared to, working in people and culture within a bigger business.
Yep. So as we kind of mentioned it early on in the chat, Chris, you were really one of the kind of first in Australia in this space. You were kind of one of the first members of Fintech Australia, as my understanding, really involved at the early stages there as well. When you kind of look, over this last 7, 8, 9 years that you've been with you've had the Stockspot business, kind of what's your view as to where Aussie fintech is now, and what do you think kind of is the next phase for it?
I would say that, my broad observation would be a lot of the businesses that have, set up in Australia over the last 5 or 8 years have been, businesses that have worked in other parts of the world and have been dropped here and localized to some extent. And that's, quite normal. It's happened, through the ages, even looking at sort of the earlier, .com businesses in the early 2000s, they were often just replicas of models that were working in other countries. And I think, some have worked, some haven't. I think what you'll probably see going forward is the next wave of fintechs probably being more focused on, uniquely Australian problems or, opportunities. And I guess super is one example, but even, I think an interesting area at the moment is how much equity, for instance, people have tied up in their homes, and the fact that our mortgages are structured in a certain way where the interest rate you're locking in is usually only for a short period, whereas in the US it's a long period. And all of these differences in the dynamics of the market, lead to different opportunities for fintechs to be able to solve for people. So I think you'll probably see, more Australian specific models that, you don't always see a similar business in another market. I think also you'll have to see, just because of the environment we're in, a lot more non-capital intensive businesses, because the cost of capital, is high and only going up at the moment. A business that's going to take $30 or $50 million to get up and running to see if it's a success, you're going to really struggle to find, funders of those types of businesses. So you'll probably see a shift back to, more lean business models as well.
Yeah, I mean, a lot of that capital has been thrown at Google ads, Facebook ads, and recruitment fees, right? It's crazy.
Yeah, I mean, there's a lot of cost to getting up to set up, and obviously the people cost in Australia is only been going up as well. Yeah. So I think there's going to be a bit of a reality check for new and existing fintechs to really make sure that their model can survive a period of lean outside capital.
Yeah. Is there any area of fintech that's got you excited right now?
I mean,
Crypto,
one that I
clearly not.
I mean, outside of our area of investing and super, I think one area that's I've always found quite fascinating in Australia is this idea of the lack of flexibility in renting, but also the lack of flexibility in owning in Australia. If you own a house, you basically own a part of it and you owe the rest to the bank. And if you rent, you're just servicing someone else's loan or paying for use of an asset. That seems like quite an inflexible model to me. And I would have thought, particularly as our population ages and they become quite asset rich with a lot of money in their family home, but quite cash poor, there'll need to be more innovations to help older Australians release some of the value of the equity in their homes. And there's been a few interesting models in that area that have come out, but I expect there'll probably be a lot more over the next few years because it's just such a big it's such a big opportunity. I think we've got $9 or $10 trillion tied up in residential property in Australia.
Yeah.
So there's a lot of money there that could be more productive in our society if people could work out how to unlock it. And I think, fintech's in a good position to do that.
Yeah.
I mean, I think they're the sorts of opportunities I find more exciting than, those ones that you love a lot more, like Web3. I'm not into the exciting ones that you are, Dexter.
Mate, I've been pretty vocal about Web3, I think, and not in a positive way.
No, I know. I'm being facetious. Watch your tweets on them all the time.
There's a lot of noise, right? And I think that's the kind of thing that I'm hoping, a bit like you, that this period gets us to really focus on what are the problems that we're solving here. And look, innovation's great. Kind of experimentation's great, but there's a lot of promise still left on the table that, fintech 1.0 still hasn't fulfilled, never mind fintech 2.0. So I kind of really do feel that, on the whole, the fintech industry owes it to the general public to start really kind of delivering and fixing some problems that I think we're going to have a lot of problems to fix over this next decade. Particularly socioeconomic and kind of environmental challenges.
Yeah, and I think it also highlights that I think it might be a risk that a lot of people that have switched industries or gone into these more, front edge of technology roles over the last couple of years is that you can get your timing wrong on this and that can have a big impact. So, for instance, if you in 2001 got into, a technology business, even though you were right in the long-term trend, it would have felt awful for the next, 7 years and you probably wouldn't have ended up in that role, or very few would. So I do think there's probably been a big wave of people to move into, some of these cutting edge technology jobs over the last year because it seemed like an attractive area that pays well and is at the edge of, cutting edge of technology, but where the fruits of that technology take longer to come into fruition. I think there'll be a lot less of those people that really see through the period of time it might take till actually the benefits are seen. And if that's 5 years, you could be right on the long term, but you could be very wrong on the short term. And you've got to, if you truly are passionate about that, you've got to accept that there could be a long, hard grind before you actually see any of that stuff you're excited about.
Yeah, look, and kind of what I keep hearing at the moment is, during the dot-com crash, you had great businesses like Google and Amazon come out of that. Say, okay, that's two, right? What about everybody else, right? We're talking about millions of businesses that ain't going to make it. And so, to your point, just going into, taking an industry or a technology and saying, hey, look, it's going to, it is a big roll of the dice. What's been really interesting though, Chris, is this last couple of months has just reflected in the job briefs that we're getting. And it's kind of a move back to, what I would call good old fashioned general management and P&L management. And it's interesting to see a number of, candidates out there who start their careers 12, 10 years ago who haven't actually got experience of increasing top line and kind of keep controlling the bottom line, right? And it's just 101 P&L management skills. And I think it's kind of a reflection on this growth at all costs mentality that we've had in businesses.
Yeah. I think that's a very interesting observation, and you'll probably see a lot less, growth hacker roles and a lot more, people manager and P&L management, and that makes sense based on the environment.
So what can we expect from Stockspot in this next 12 months, Chris?
I mean, based on where we are with the markets at the moment, I think it's going to be a bit of a tough slog for our sector and for people investing generally over the next, period of time. We've been able to sustain the volatility relatively well. The ups and downs of markets, have been tough for a lot of investors. And, even though we've seen some very quick recoveries, like in March 2020, markets bouncing back up, it doesn't feel like it's going to be, like that this time. So a lot of our work over the next, year, I imagine, will be in, helping our existing clients continue to invest through a tougher time, helping them dollar cost average, helping them set their long-term goals and really, keeping them invested, even though it will seem like it's not the right time to invest, because we know the people that do continue to invest through tough times, they'll be the ones that really, do very well over the long run. So I think, looking after our existing customers becomes more of our focus than going out and getting a lot more new customers. The new customers continue, but at I think a slower rate than what we saw in 2020 and 2021, where there was just such an influx. For us, it's an opportunity to prove that our investing model works, that by diversifying, keeping your costs low and not jumping at every news headline to buy and sell, that actually is going to set you apart over the long run. So I think for us, it's great to have this part of the cycle as well, because our business model kind of works in all parts of the cycle, but we actually need investors to realize that markets don't only go up. Because if markets only went up, then there'd probably be other businesses that, are better for people to use than ours, because there'd be no downside to protect, which is, what our focus is.
Well, Chris, it's been great to have you on the show. Where can people go and download the Fat Cat report?
So I would suggest just coming to the Stockspot website is easiest. So that's stockspot.com.au and /fatcat, FATCAT. And that report's free for anyone to download if you want to get some tips on how to invest your super.
Awesome. Well, Chris, thanks for joining me. It's been great to have you on.
My pleasure as always. Thanks for having me back.
And you can connect with me on Twitter and LinkedIn. If you're coming back, thanks so much for your support. And if you're new to the show, make sure to follow us and leave a review. Until the next episode, stay safe